Hi, and welcome to a new video with Athena Quant. Ever looked at a stock chart and felt like you were just staring at a bunch of random noise? Well, what if I told you there are hidden messages in those squiggles? Today, we're going to learn how to decode them, turning all that historical data into a real, actionable trading edge. This right here is the core principle for everything we're about to do. The market isn't just a series of random coin flips, What happened yesterday or last week, it leaves a footprint. Our job is to learn how to follow those footprints. And that's the big question, isn't it? It's one thing to say there are patterns out there, but it's a whole other game to actually find them and build a strategy that works. So let's figure out how to do just that. Okay, first things first. Before we can predict anything, we have to ask the most fundamental question. Are we looking at a predictable signal or just a bunch of random static? The key to unlocking that answer is a concept called stationarity. Think of it like a river. A nice, calm river might meander a bit, but it generally stays within its banks, right? It has a predictable mean, a path it returns to. That's a stationary series. A non-stationary series? That's a river during a flash flood. It's chaotic, carving a new path, and totally unpredictable. As traders, we want to be on the calm river, not in the middle of the flood. And here's what that looks like in the real world. On the left, you've got a typical stock price chart. It looks like a random walk. It's just wandering aimlessly. But check out the chart on the right. That's not the price, it's the returns. See how it constantly snaps back to that center line? That is stationarity in action. And that is something we can actually model. So, how do we prove it mathematically? We use this thing called the augmented Dickey-Fuller test. Now, don't let the complicated name fool you. It's basically just a randomness detector. We start by assuming our data is random, and we challenge the test to prove us wrong. If it spits out a low score, what we call a p-value below 0.05, then congratulations, our data isn't random. It's predictable. All right, we found a predictable series. That is a massive first step. But, even predictable data can be really noisy and messy from day to day. So our next job is to filter out all that static so we can hear the actual signal. And our go-to tool for that is the moving average. Honestly, the best way to think about it is like a pair of noise-canceling headphones for your data. It just smooths out all the short-term jitter so you can focus on the real underlying trend. Now, we've got two main flavors here, and the difference is all about how they treat past data. The simple moving average, or SMA, gives every day in its window an equal vote. The exponential weighted moving average, the EWMA, is different. It cares way more about what happened recently. So the SMA is kind of like a historian. It's slow, it's deliberate, it looks at the entire picture equally. That makes it really good for identifying those big, stable, long-term trends. The EWMA, on the other hand, is like a breaking news reporter. It's all about what's happening right now. This lets it adapt and spot changes in the trend much, much faster. So what does that mean for us? Well, in trading, speed is often the name of the game. That faster reaction time from the EWMA could be the difference between getting in on a move early and watching it happen without you. Okay, so we've found a predictable series and we've cleaned up the noise to get a clear signal. Now for the really cool part. How do we build a model that actually uses this information to forecast where things might go next? For that, we turn to a model called ARIMA. It's basically a blueprint for how a computer can understand a time series. The R part means it looks at its own past values for clues. The I part just confirms that we've made the data stationary, and the MA part, this is really clever, it tells the model to look at its past mistakes and learn from them. All right, now it's time to put all these pieces together. We're going to take every concept we've covered, stationarity, smoothing, modeling, and apply it to an incredibly powerful strategy known as pairs trading. It all starts with what sounds like a paradox, a little magic trick. Can you take two completely unpredictable things, combine them, and get something that is predictable? Sounds crazy, but the answer is a resounding yes. And the secret sauce is this beautiful idea called co-integration. Picture two dogs running around a park. Individually, their paths are totally random, but what if they're on the same leash? They can still wander, but they can never get too far away from each other. Co-integration is that leash in the financial markets. A classic example of this is the relationship between gold itself and gold mining stocks. By themselves, they're unpredictable, but their fortunes are obviously linked. Because of that, the spread, or the distance between them, often behaves like a stationary series. It has a mean it wants to return to. And here's the playbook for how you trade it. Step 1, you find two assets that are on that leash together. Step 2, you track the distance between them. Step 3, when that leash gets stretched way too far, when the spread widens, you make a bet that it will snap back. You sell the one that's outperforming and buy the one that's underperforming. And step 4, when the spread comes back to normal, you close the trade and take your profit. And this right here is the whole game. It's a total shift in perspective. You're no longer guessing if a stock is going to go up or down. You are trading the stability of a relationship. You're not trading the dogs, you're trading the leash. So there you have it. We've gone all the way from raw, noisy data to a sophisticated trading strategy. We've learned how to find a signal, how to clean it up, and how to trade the hidden connections between different assets. So now the only real question left is, what relationships are you going to go out and discover?